Welcome to lesson 2, part 3, where we are going to discuss the futility of trying to predict what is going to happen in the stock market. I am your teacher and mentor, Mntom'nyama. Naturally, the first question one will ask is, what is the stock market? Simply put, a stock market is a place where people buy and sell shares of publicly listed companies. Let's look at it this way. When you want to buy food and groceries, where do you go? You go to a food supermarket. And in that supermarket, there is all kinds of foods and related products selling at different prices. Similarly, a stock market is like a supermarket of companies where a variety of businesses are on sale on a daily basis and at a variety of prices. To name but a few of these markets, we have what we call the Johannesburg Stock Exchange, which is in South Africa. We have the New York Stock Exchange and the Nasdaq, which is in the United States. Now, when we buy food in a food market, we buy it for consumption, isn't it so? But when we buy shares of businesses at the stock market, we do it to make money through either dividend payouts or capital gains. So if there is a potential to make money, it means there is also the possibility of losing money. This is because a typical stock market has got at least hundreds, if not thousands, of companies listed and therefore on sale to the public. Only a small portion of these companies are great and profitable businesses that are suitable for investment. So one has to know how to find these hidden gems in a haystack of mediocre businesses, and this is a skill you will learn in this course. Now we can agree that most people want to retire comfortably, which means having enough monthly income to sustain their desired standard of living. To achieve this, one of the options is to start your own business, which could be a very rewarding but nonetheless daunting task, as you'd have to bear the full responsibility, hard work, and risk associated with starting and running your own business. Another option, or in addition, one could own parts of an already established and successful business by buying and owning shares of that company. One can share in the profits of that business without having to get involved in the day-to-day running of that business. And that is what the stock market affords us as investors. This is what Warren Buffett did, and that is how he built his enormous wealth. From the age of 11, he started buying shares of great companies and was at one point the richest man on earth. He did this, as far as I know, without ever starting from scratch a single business of his own. So if Warren Buffett can do it, we can also do it. Why? Because the stock market is neutral, which means if I apply the same principles that Warren Buffett applied, I can also over time accumulate my own personal wealth, and that is the magic of the stock market, ladies and gentlemen. Okay, now let's talk about how the stock prices move. For there to be a transaction, there has to be a buyer and a seller. In other words, if I want to buy a share of a business, someone has to be willing to sell it to me. And if I want to sell a share of a business, somebody has to be willing to buy it from me. So there is always two participants in any given transaction. On the one side, we have a buyer, a person who believes that the price will go up, and that is why he is buying. He is said to be bullish because he is optimistic that the price will go up. These people are called bulls because when a bull strikes, it swings its horns upwards, which is a symbol of prices moving upwards. On the other side of the transaction, we have a seller, which is a person who believes that the price will go down, and that is why he is selling and taking profits. He is said to be bearish. These people are called bears because when a bear attacks, it swings its paws downwards, which is a symbol of prices going down. Prices move because there is an imbalance between the quantity of buy orders and sell orders. If buyers buy up all the shares that have been made available by sellers at a particular price, and there is still an excess of buy orders, prices go up. And vice versa, if there are more sell orders than buy orders at a particular price level, prices go down. Simply put, it is all about supply and demand. If buyers place more demand for shares than sellers can supply at a specific price, prices of the stock move up and continues to move up until it reaches a level where there are sellers who are willing to sell at that price level. But if there is more supply of shares from sellers than there is demand from buyers, price of the stock will go down. So it means for prices to move, there always has to be two sides that disagree about the direction of the stock price in the short term. And when I say short term, I mean within the next day, week, month, or even 1 year. If everybody agreed on the direction of the stock price, the price of the stock would not move. There would be no transaction and hence no market. Comprende? Okay, let's move on. I hope you guys got this. Another important aspect you must learn early in your investing career is this. No one can predict with absolute certainty where the stock market price will go in the short term. And again, by short term, I mean within the next day, week, month, or even 1 year. We can only make calculated guesses of the probability of one thing happening over another, but never with absolute certainty. Anybody who claims they can tell you exactly with 100% accuracy what is going to happen next, either because of some fancy technical indicator or whatever tool or reason, that person is lying to you. Of course, over the course of 5, 10, 15 years, we know that the stock market will always go up because the stock market always goes up in the long run. We know that prices of great businesses will always go up over the long run. But the media is set up in such a way as to convince as many retail investors as possible that they, the media, know what is going to happen next in the stock market. And they do this in order to influence the investing decisions of these unsuspecting investors, decisions of when to buy and when to sell. They prey on the emotions of ignorant retail investors who follow and act on predictions and advice of so-called experts. Experts who are proven wrong most of the time. Yes, they will get it right once in a while, but remember, a broken clock is right at least twice a day. So how is the media able to influence these unsuspecting investors? Through the emotions of fear and greed. When inexperienced investors are fearful, they tend to sell their shares in panic, causing the price of the shares to drop sharply or drastically. And that is when experienced investors buy up great companies at abnormally low prices. On the other hand, the emotion of greed has the opposite effect. When inexperienced investors are in a state of euphoria, which has been drummed up by the media, they tend to buy shares en masse, causing the price of the shares to rise rapidly. That is when experienced investors sell their shares at great profits. And at the heart of this is the mainstream media, drumming up the news to create the required narrative. But now you will ask, why would the mainstream media do this? Remember, the media works with big institutions. When the big institutions want to sell large quantities of shares at the highest possible profits, they need ignorant retail investors to take up the buy side of the transaction. So the media will hype up that particular stock. So-called gurus will appear on TV advising people to buy that stock so that the institutions can sell at the highest possible price. Vice versa, when the big institutions want to buy stock of a particular business, they want to do so at the lowest possible price. The media will then publish bad news to create panic selling, especially among retail investors. And guess who would be on the buy side of this panic selling? Yes, you guessed it right. The big institutions and experienced professional investors like myself, picking up great businesses at very low prices. Let me show you a few articles that create fear in the market and causes this panic buying that I'm talking about. Let's look at these articles. The first article was on October 17, 2023 by Teron Mohammed. The S&P 500 is in a historic bubble and could crash by 63%, market guru John Hassman warns. Another one, Paul Krugman, closing his mouth with his hand. The economic fallout. Ooh, so scary. The stock market could plunge as much as 27% when the economy finally tips into a recession, investment research firm says. Something is breaking in financial markets. Here's what is behind the sell-off. Stock markets face a perfect storm as high rates and China fears bites, analysts warn. Global economy sets for its worst half in a decade of growth in 30 years, World Bank says. JP Morgan stock guru Kolanovich sees several negative catalysts for the market. A notorious market bear who called the 2000 and the 2008 crashes dispels the notion that a Fed pivot will lift stocks and warns that the S&P 500 could fall as far as 65%. So all of this is meant to create fear and panic in the markets. And the list goes on and on and on. But despite all this fear-mongering, let's look at this. Despite all this negative publicity and fear-mongering about the collapse of the stock market, the S&P 500, which is a good measure of the performance of the stock market, continues to go up, as you can see on this chart. As you can see, it has gained 152% over a 10-year period, which equates to an average return rate of 14% per annum, which is very good for the S&P 500. Let's look at another example. When we compare the S&P 500 with major global events, you can see that even with major negative global events, you can see that from 1970 to 2022, the stock market has always been going up. It has always been going up, despite all the negative global events. Now, it does not mean that it will go up every single year, but definitely most of the time, the stock market goes up in the long run. Now, when we compare the S&P 500 with all the major wars that have occurred, we can see that the same story remains. Despite all the negative wars, all the global wars that have taken place between 1928 up to 2021, the stock market continues to go up in the long run, as you can see over here, still going up. So what is the moral of the story? What are the take-home points? Number one, ignore the bad news, the hype, the fear-mongering, and so-called expert predictions and advice from the media. Base your investing decisions on the fundamentals of the business in question. In other words, no one can predict with 100% certainty what the stock market prices will do in the short term. And that is why you cannot be listening to the media. Number two, which is good news. You do not need to know what is going to happen next in order to make money investing in the stock market. Now, it is very important that you get this, guys. This is the crux of the matter. Now, to give you one final example, during the 2022 bear market, technology stocks took quite a beating. There was huge negative publicity on these stocks, especially the technology stocks. There was huge negative publicity. Experts and gurus came in left, right, and center, speaking negatively about the technology stocks like Adobe, Meta, Amazon, Alphabet. They said that these companies are going down, they will never bounce back. And if so, it will take a long time. Now, I had been watching these stocks for quite a while, including Adobe. And at that time, we had this guy called Dan Suzuki who came and said, there is more pain ahead for technology stock once Ben stands Dan Suzuki. And he made this comment right here at the bottom, right at the bottom of the crash, just before the crash stopped, just before the crash concluded. He was making this prediction that there was going to be even more pain. But guess what we were doing as experienced investors? We weren't listening to him. We were buying. I actually bought shares of Adobe at these levels here. And this was around September 2022. And 14 months later, what happens? I am in profit. I am almost 213,000 rands in profit 14 months later. And the moral of the story here again is, do not listen to the media. Do not listen to the fear-mongering and scare tactics. Focus and base your investing decisions on the fundamentals of the business in question.